Good day, everyone. There's been a lot of miscommunication around the pricing of silver, and today I have David Morgan, an expert in the silver space, to help us unpack all of it, right from the LBMA to the London's Metals Exchange, the Shanghai Exchange futures, and much, much more. So this is a video you're not going to want to miss because of all the misinformation around the pricing of silver in particular, and that's what we're going to be focusing on. So, David, thank you for coming on my podcast one again. We spoke back in September when the metals was a lot lower and obviously we're much higher in pricing. But I get the sense that there's just people are speculating on the silver short positions, what that all means, the pricing on the COMEX. So I really wanted you to come on and help us explain all of this for the average investor who may be new to the metals or even some of the people that have already been in the metal space.
Well, thanks for inviting me. It's good to be back with you. And yeah, I made some notes because you reached out and kind of outlined some of the talking points. So let me just start off with, what the major metals exchanges actually are designed to do. And most investors assume the major metals exchanges exist to set a true price for the physical metal, but that is not their primary purpose. They're designed to transfer price risk, to provide liquidity, and to enable financing and inventory management. Some call it financialization. You can look up the word. It means that silver and gold and other commodities are basically put in the financial system. And what runs the financial system? The fiat money system. So really, they're financialized. So as we all know, or most, maybe new people are very unfamiliar with these terms, but the silver market, the gold market, is a derivatives market. And that's what the design is intentionally. So someone that thinks, oh, you got to put the silver in the COMEX before it's delivered somewhere is gravely mistaken. Very little of any commodity, be it soybean oil, or cotton, is on the exchange for delivery. It's there kind of as a backup last resort. We could deliver it. But the primary purpose is outlined: price, risk, hedging, liquidity, and inventory management. So back to you.
Yeah, I agree. And I think we see a lot of miners that use the futures pricing for hedging and stuff. So um getting right into it, I mean, let's start off with the COMEX. I mean, there's supposedly a huge short position by the silver bullion banks, they call them, and they seem to be demonized out there. But I do believe there's an actual role for them to play in the metals market. So yeah, let's get right into talking about maybe the COMEX.
Sure, let's go right to the COMEX. So what is the COMEX designed to do? So it exists primarily so producers can lock in future prices. And that was the whole purpose of the futures exchange from the very get-go. I mean, in the very start, it was basically agricultural commodities like wheat and corn, and the farmers wanted to lock in a price and have a profit and weren't worried about getting the last nickel per bushel. They wanted to make sure that they were able to lock in a price, and that's basically how it started. So it's run amok. I mean, all these markets are outside of, they're more casinos now than they are actually physically determined markets, because there's so much leverage and derivatives in the system. But I digress. So that's to lock in future prices. It's for fabricators and manufacturers to hedge their input costs, like a farmer, like I just said. Banks and liquidity providers can can intermediate risk. So they can lay off some risk to a speculator or another bank or a hedge fund, whoever wants to take the other side. And speculators provide liquidity by taking on the trade. So most of your trades in all futures, be it soybean oil, cotton, cocoa, or silver, are almost habitually long. Not always. Some speculators are short, but it's a market of derivatives in all the futures. So there's two distinctions that need to be known by the communities. Most that would be listening to you probably know this, but there's two positions. One is called registered and another is called eligible. The eligible metal, that meets all the exchange standards, but it's not for sale. So this would be someone like XYZ Trading. that maybe has a hedge fund that's all metal, maybe gold, silver, platinum, palladium. They take in cash, they buy the metal, and they have to store it somewhere. Well, one of the best places to store it is in a warehouse or a vault that's COMEX approved. So it sits there. Their title is held by the owner or owners, and it just rests there. And there's fees to vault it, and those are paid, and it just rests there. So it could be there for years, and it may never be sold through the exchange. It could be sold, since it's owned by whatever entity, it can be sold and delivered off the exchange without having to go into the registered category. So there's that. The registered metal is warranted. It means it has the tag on it and is available for immediate delivery. So right now, the amount of registered is, I think, 135 million ounces in silver, and I don't know, around 300 million or so. I can look it up while we're talking, in the eligible category. So there is a very strong amount of silver sitting in the COMEX right now that could be easily delivered. I just want to go on another minute here.
Sure.
But right now, there was a tweet on X talking about the first notice day and how many stood for delivery. You hear this every month almost, and everybody stands for delivery, and the COMEX is out of business. Well, if those numbers are true, that's pretty easy to calculate. But what was false is the amount that was calculated was totally off base. Didn't understand the real significance of the first notice day. And the amount, I calculated it out, if all of it that actually went through was stopped and had to be delivered, was only 4.5% of the amount of registered that was in the vaults already. So it was like not even close to draining the vaults out. So the delivery reality on all commodities that less than 1 to 3% of contracts ever stand all the way through delivery. Most contracts are rolled, which means they're in December, they roll into March, and then they roll into May, the next delivery month, then roll into September, the next delivery month. So the paper game just continues going forward. So most of them are rolled forward, offset. So you could have your own trading house could be long and short at the same time. Called a spread. It's to capture the contango. It's very sophisticated for people that don't understand it. It's actually kind of safe money, or cash settled. And so, again, there's a lot of misunderstanding what takes place. And lastly, the COMEX function, even if physical inventories fall, or fail rather, then you would have a break in confidence. And a lot of people, myself included, said that that possibility does exist. And I will not back off my words, but a possibility is a lot different than a probability. And right now, the probability of a failure at the COMEX to deliver physical is pretty remote based on the amount that's in the registered category right now. So I'll give it back to you. We could talk about the LBMA.
No, that's great that you've helped us explain how the COMEX works in terms of pricing of what's available for delivery. I think a lot of people need to understand that. And when you shared the information of only a few percent is actually delivered to the market, and that there's a lot of metal in the space, it will help people understand that, yeah, we could be seeing a short squeeze, let's call it, in the price, but there is metal there to back it all up. And I don't know what your thoughts are on the talk around the bullion banks being heavily shorted and failures of these bullion banks. Maybe we want to touch on that very quickly before we go into the LBMA.
Yeah, I just published my latest report over the weekend, and maybe I can pull it up here real quick. But one, before I get to bullion banks, don't let me forget if I start talking and lose my train of thought. But first of all, there's a lot about, there's 300 to 1 coverage on silver or gold. There's 300 claims on this gold, and there's only 1 ounce. There has been times where it may have been in that category, but not anymore. If you look at the COMEX, the cover ratio is about 10 to 1, with registered only, and if you go into eligible, it's like 6 to 1. So it's nothing close to there's 100 contracts for every ounce of metal. That's just BS. Now, to be as objectively and truthful as I can be, that number can be verified with basic arithmetic. What I cannot do is look at what the options on futures numbers are, or what may be off in the OTC market, which isn't verifiable, which could be like the LBMA. So you could be long in the COMEX and short the LBMA, but still a much more realistic number is leverage of 10 to 1 than 100 to 1, 300 to 1.
Right.
But you hear that constantly. As far as the bullion banks, that's where it's really the most misunderstood. And the bullion banks get talked about being naked short all the time. And that's kind of a constant meme that you hear over and over again. And the truth of the matter is that the bullion banks are actually pretty conservative. Bankers generally, or at least in the older days, used to be very conservative. And bullion banks usually are hedging positions. They are not speculating naked. Now, that's not to say there are no naked shorts from bullion banks. That is not what I'm saying. However, it is much, much, much less than what the general public believes to be true. And I wrote about this, as I said, in this month's report, which I just published a few days ago. I had a lot of questions to the editor because there's been so much information, which we talked about off air before we hit the record button. So here's one that came into me. Okay, letter number 2. I never understood how they can stand the large margin calls that one would think they faced when silver's doubled in the last year and gold has doubled since January. Collectively, their losses must be in billions of dollars. You would think that a trading desk worthy of the name, like a certain bank, would have covered before getting into this kind of a fix. How do they make margin calls? So here's my long-winded comment, but we're here to set the record straight. Silver's long-term price behavior is fundamentally a supply and demand story. Industrial demand continues to grow across solar electronics, electrification, and grid infrastructure. Mine supply remains constrained. Above-ground inventories have been drawn down for years. Large wholesale bars are increasingly difficult to source without delay. However, the noise surrounding silver claims of imminent collapse, total naked shorting, or guaranteed delivery failures exists largely because paper markets move faster than physical markets and because of extreme narratives to attract attention that don't know what the heck they're talking about. Over time, however, physical constraints also could dominate the financial system. History bears this out. The bottom line is this: not all shorts are naked. Banks are primarily hedgers, not reckless speculators. And I yellow highlighted that, and I'll say it twice. Banks are primarily hedgers, not reckless speculators. 3, most naked exposure comes from funds, not commercials. Commercials are the producers. Futures markets are pricing venues, not warehouse guarantees. Silver's trajectory ultimately depends on physical availability, not headlines. Understanding these distinctions allows investors to remain focused on what matters and avoid being distracted by stories that confuse scale, structure, and risk.
Well, I'm actually happy that you discussed the bullion banks and that their role is really hedged position. So they really don't have that exposure of being naked short as many people discuss. In fact, I recall reading something, um, even JP Morgan, which I don't know if we're going to talk about it, but they covered a lot of their position back in the summertime. So they're not, I would almost suspect they're not long at some point and taking this free ride in the metals price that's risen. So it's there's a lot of speculation on some of these bullion banks failing and blowing up. I just don't see it unless you get that one outlier case. And it's probably not even the big bank, it's some hedge fund that just went long one side or short one side. And they're more at risk than any of these bullion bank dealers that are involved. So I'm glad you shared that information with us and kind of set the record straight on what their role is and how they actually act in the market. So
The whole banking system, as much as I dislike it, I mean, they are risk adverse. They want a sure thing every time they can get it. And one
sure.
of the things is the basis co-basis, and I don't have time to go into it, but Keith Weiner does at Monetary Metals. But basically, they're just making a little bit of a edge on a differential between 1 month to the next, but they're leveraging that. So instead of getting quarter point, you do it times 10, you're getting 4%, 4% a month. That's pretty big money if you multiply it by 12.
Yeah.
So, so there's that. And then thanks for giving me the forum. I'm not here to defend the bullion banks, believe me, but I'm also here to be objective and truthful. And the other thing that most people don't think about is what happens if you're a miner and you're mining silver or gold, or you could talk about tin or aluminum if you want, but so who's the buyer of last resort? No one wants it. I mean, industry's got all they want. They've got a 3 month supply ahead of them or whatever. The retail investors are burnt out. They don't want to buy silver at these prices. Well, if someone buys it, who buys it? Well, the bullion banks buy it. That's
Yeah.
who buys it. They're like the buyer of last resort. So they are a market maker, and somebody has to be a market maker. Again, I don't want to sound like, oh my God, I've lost faith in David. No, please don't lose faith in me. I'm trying to shoot straight and make people understand that the story is so bullish and so profoundly positive for both gold and silver. We don't have to make these exaggerations. There's no need for them. And plus, it confuses the market. It actually keeps people away from the market that, in my opinion, that might otherwise come into the market because it sounds so manipulated and so controlled and so out of a viable opportunity that people stay away from it because of all this misinformation.
Yeah, I'm glad you shared that information. And let's kind of get right into maybe discussing both the LBMA, the London market, and the Shanghai at the same time, and their basic roles in the market. But we do see a lot of talk, and especially between the Shanghai price of physical versus the COMEX, and that there seems to be this big spread between it. And does it even make sense for someone to buy COMEX, take delivery, and then deliver it into Shanghai and then take that big arbitrage that you've got there?
All right, let's address the LBMA first. The London Bullion Market Association is wholesale clearing. It's not a warehouse. The LBMA is designed as an over-the-counter wholesale market. So, like I said earlier, there's no real big statistics that we can verify there. But it is a clearing and settlement system. It's built for banks, central banks, refiners, and large institutions. It's not an exchange in the retail sense. They have unallocated versus allocated. Unallocated is a credit claim on a bullion bank. Allocated is specific bars, serial numbered, and client owned. Most LBMA volume trades unallocated. This means multiple claims on the same pool of metal, minimal physical movement, and heavy reliance on trust and balance sheets. This works perfectly, quote unquote, until too many holders ask for allocation at one time. And we have witnessed that recently. So on the Shanghai Futures Exchange, that's a different animal. And this is where the game gets more interesting because the Shanghai Exchange has not been around all that long, and it's definitely made a difference. So the Shanghai Futures Exchange is physical first and domestic priorities. What the Shanghai Exchange is designed to do, China has built its system to serve domestic industrial demand. Let me say that again. China built the Shanghai Exchange to serve domestic industrial demand, ensure physical settlement, and reduce reliance on Western price discovery. The key differences are delivery rates are far higher than what they are. Like I said, at the COMEX, which is about 1 to 3. Contracts are structured with physical intent. And three, metal generally does not leave China, especially with this new licensing uh, situation that the Chinese put in on the 1st of this year, 1st of January 2026. Shanghai prices often reflect the real world scarcity, not a paper leverage situation. So, why the price differences between the exchanges? COMEX prices reflect hedging and speculation. The LBMA prices reflect clearing and financing. And the Shanghai price reflects physical demand. It's that simple. So arbitrage should close gaps, but there could be capital controls, export restrictions, logistics, which I can define a little further, trust and settlement, and availability of deliverable metal. So even though there is an arbitrage, it has to be more significant than a couple of pennies or whatever. Now, if it's a couple of pennies in paper markets, banks will take, or anyone can take advantage of that arbitrage, as long as you don't have to physically settle. When you have to physically settle, is it worth taking that metal out of New York, putting it on a manifest, putting it onto a semi tractor trailer, 18-wheeler, taking it to the dock, taking the manifest and ensuring every bar by serial number is put on the boat. The boat floats over to China, it unloads, and it's loaded back onto the Shanghai exchange, and you're paid a different price. Yes, the answer is yes. If the delta, the difference between the two prices cover all of those costs, yeah, it's worth it. But all those costs mount up. On top of that, with the market being in backwardation at times, there's no way to hedge that price differential as that metal's being transferred. Now, a deal's a deal. And if you locked it in, it should be good to go, regardless of what the price changes are between point A and point B, New York to Shanghai or London to Shanghai or Mumbai to Shanghai or whatever. But it's a little more complex than just saying, oh, the price is different, ship the metal. Shipping the metal is cumbersome, or can be.
Yeah, I'm glad you shared that because I never even really thought about the transportation and the logistics behind shipping from New York to Shanghai. And then that would actually kind of significantly reduce that arbitrage pricing that's available right now.
Got to pay all that labor, all the transportation. You got to pay the boat. You got to take the guys that do the manifest. Um, and then the hedging, if it's an issue, you're not going to take that risk. So there's a lot more to it than just, now let's say there was a lot of silver in Shanghai right now and an entity owned it and you didn't have to move it from that warehouse. Well, that would be an easy arb. You just sell it at 80 or whatever, 90, and, you know, the difference between the New York or whatever. I mean, you could do that in house pretty easy. But when you actually have to physically move it, there's a lot involved, as I outlined.
Do you think there's a lot of players in the market looking at that arbitrage right now and actually moving metals from either London or New York into Shanghai?
I'm sure there are people penciling it out, and I'm sure there's been some. I don't know how much. I don't have anybody at a trading desk I could call anymore and ask them. And I don't know these days that even talk to me. But yeah, there's the opportunity. The other thing is kind of the free market or black market. If you're in India and you've got metal that you've bought recently for 70 and it's 80, you might figure out a way to get it from India to Shanghai, yourself.
Yeah.
Depends. Markets are pretty efficient, not perfectly efficient, or would be the opportunities. But when there's an arbitrage and it's big enough, and then of course, normally the arbitrage will contract. In other words, once that specific amount of metal that's being bid higher than the spot price is satisfied, then the markets go back into a normal configuration and all the markets trade about the same. But as I already discussed, I think I did a fairly decent job and tried to be succinct. that there's a big difference between the Shanghai market, how it operates, and the LBMA and the COMEX. And that's kind of for everybody to see now. Wait a minute, they're paying more. Why is it? Because they're dealing in physical metal, and the physical metal is demanding a premium. And it's that simple.
Yeah, I tend to agree with you. And I mean, China, India, they are more the physical buyers. The West is just paper traders and trying to uh to make a profit off of it, which is fine. I mean, there's a need for that. I don't I talk to a lot of people and I see a lot of posts online. Everyone always talking buy physical, take delivery in your own possession, even the retail traders. And they all say, oh, don't trade the paper markets. You don't own it. It's not in your hands, you know. And I think of it as a bit of, I almost call it nonsense because to me, that pricing and paper game is not going to go away. But if you don't have to actually take delivery and your whole objective is to make a return on your investment, I say, use the ETFs, use the option trading, especially as prices are exploding or breaking out of a range and are going in one direction or another. You can play both sides of the market, um, which is which is why I actually do like the paper markets in a way. So,
Yeah. I'm
but
not going to push back on this. Want to be consistent because I'm people that there's people that follow everything I do. A few nutcases out there, but I slightly different than you. I just say, look, in the current environment, I've said the same thing for years. I think you should own some physical that you hold, but that doesn't have to be your life savings or even close to it. And once that's accomplished, if you want to go to ETFs or the SLV or PSLV or a paper market, I have nothing wrong. I don't see anything wrong with that. But understand what you have. People that think if they own the SLV, they own silver are sadly mistaken. So I wanted to make that determination. Most people fully understand that. But you are right. I mean, there are times when maybe the silver price has gotten overextended. And if you got a futures account or even a stock account, you can hedge that. You can buy puts on your stocks or buy puts on your silver. And the other thing is the futures market by itself. I mean, I got in on the last big run, which was like what, 2011, and I called. It was a long-term channel formation. People that understand what that is, you can look it up on Google if you don't. It broke out of the channel at 19. I went long and told all of my members I'm going long at 19. And it went all the way to 26. And that's a pretty big move in those days. So we're up $7 in a fairly short amount of time. And I backed off. I took the 7. And then right after I took the position off, QE2 was announced. So I went right back in at 27. I got very little slippage and went and rode it all the way up to 48 and called the top. So there were people that followed me in on that trade and retired. They wrote me very complimentary emails.
yeah.
I'm not saying people should trade futures. All I'm saying is a good futures trade can make up for a lot of mistakes if you do it right. And another one I did recently was a spread trade. I went short palladium and long platinum. Platinum did nothing. It went sideways. But palladium went from like 1,000 down to went from 2,000 down to 1,000 and basically kissed the same prices as platinum. So when they were on par, I took the trade off, and that trade went for months and months. But when you're on leverage like that, and the spread trade has a lot less margin, it's really less risky. So I think there is a time and place for all of it. I'm not trying to talk people into doing futures, but what I am saying is, look, I like the markets, and there's a time and place and condition depending on you and your personality. I have people that want physical only, have no stocks, don't have a stock account, will never have a futures account, but they still want some guidance on timing, and I'm happy to help them. And I have people that are, they're writing calls on leaps. If you know what a leap is, a long-term option, basically. So it takes all kinds, and I think the market's availability is great, that you should be able to choose. What I don't like is um, how far from reality all the markets have become with too many derivatives and too much leverage in the system.
Great. Well, thank you, David. We're gonna wrap this up right now. I'm glad you shared all the information on the COMEX, LBMA, Shanghai, the paper markets. I believe in hedging as well. So I mean, I I will go short some of the ETFs at times. And why not? I mean, if it's, if it's gone overextended, short the thing because you'll make some money on the downside as well as the upside. Um, I think there's a bright future in the silver miners. That's going to be a whole different podcast. We can maybe circle back and discuss the miners because as silver has risen about 130, 140% last year, the silver miners, the SIL has only done 150%. So really you didn't get the leverage. And I think that's where the sweet spot is for me right now in the investing side of silver going into 2026. I'm looking at some of the producers that are growing, juniors, and even some of the exploration plays. But maybe we'll come back and discuss that on another podcast. But thank you, David, and we'll talk soon.
Very good. Thank you, Ben.
And I'll share your contact information in the description below, how they can reach you or subscribe to your newsletter. And we'll chat soon. Take care. I hope you enjoyed this video with David Morgan. He shared a lot of information about the pricing of silver and metals in general and how it works on the COMEX, the LBMA, and the Shanghai Futures Exchange. He also explained the role of the bullion banks, hedging, and we also discussed paper pricing and paper trading. If you did enjoy this video, I highly encourage you to watch our other video with David Morgan as he discussed the price of silver and silver mining in Mexico. That was recorded back in the fall. And feel free to watch our interview with Michael DiLorenzo from the Silver Institute. That was also recorded in the fall, and we plan to have him on later on this month, towards the end of the month on this channel, to do an update interview, as well as next week we'll have Jay Martin on, and then a few other special guests. So if you enjoyed the video, please don't forget to like and subscribe and continue to follow Financial Liberties and Vin Maru as we unpack how the financial system is changing the roles of the metals and crypto and all other things that are going to be tokenized in the future. Take care and enjoy.